everyone, and welcome to this webinar. It is the time of the year when Coface UK and Ireland organizes its country risk conference, and obviously this year circumstances have dictated that we do something else, a shorter event, but nevertheless we thought it was important that we again try to delve into some of the challenges which the economy faces and more generally trade and supply chains have to face. So I am delighted to welcome John Nicholas, the Chief Underwriting Officer for Coface UK and Ireland, and Patrick ARTUS. Patrick is the Chief Economist of Natixis. He is also a member of the Executive Committee of the bank. So John and Patrick will try to answer some of the questions which you may have or we have had over the last few weeks. You may have seen that the Bank of England has already stated that there were some green shots in the UK economy. So John will carry us through some of the challenges of the UK economy and in particular what's going on in terms of trade risks. He will hand over then to Patrick, who will take us to the more global view, in particular about where does the money that is pumped into the economy come from. All this debt that has been accumulated or which is created, is it an issue, either short-term or long-term? Other questions might include also the balance of power between emerging markets or China and the US, for instance, or emerging markets and the rest of OECD, whether industries will start to relocate. We've seen that there were very long supply chains, very intricate supply chains, which have suffered in the last few weeks. Will this change? Will companies adapt? And obviously, you might have some questions about other topics such as Brexit and others. So there will be the possibility to raise questions. You just type them, and I will try to summarize and distribute them to John and to Patrick. And without any further ado, I would like to hand over to John to talk a bit about what's going on in the UK currently and the view of Coface in the UK. Thank you very much.
Situation, as Patrick will be covering that in a bit more detail in his presentation. However, I thought I'd just share a few sort of key forecasts from Coface's own economics department and highlight some trends, more importantly, that we're seeing, at least on a UK level, from our claims and collections data that illustrate well the deteriorating cash flow within supply chains. So moving on to the first slide. So as I said, these come from Coface's own economics department, and our latest forecast for world GDP growth is a severe contraction of 4.4% this year. This will be, necessarily followed by a recovery of 5.1%. However, I think, as you would have probably seen, many forecasts from different institutions, and ours is based on a scenario that assumes, say, for example, no material second wave of the pandemic. And what we're finding, because of the unpredictable nature of both the health and economic crisis, as well as various other geopolitical uncertainties such as Brexit, future trading relationships with China, it's very difficult to make any accurate predictions, and hence places like the Bank of England regularly revisit their own sort of forecasts. But the point is that the economic impact on the major economies will be severe, and although they will vary a little bit, with BRICS perhaps being more resilient than when contrasted with Europe, but most economies will be smaller at the end of 2021 compared with 2019. So moving on to the next slide, and what does that mean from the credit risk perspective? I think a key point here is the fact that as I say, from the credit risk perspective, the heightened risk of insolvencies associated with a recession as sharp as this actually remain and arguably are greater in the recovery phase. So when Coface are looking at its forecasts, we're looking at the cumulative effect through to the end of 2021, and you can see that because of the economic consequences of this global recession, they're going to span virtually every industry sector. There's probably just a few exceptions, such as certain technology and pharmaceutical businesses as obvious examples. But there'll be zombie companies that are going to fail because of as the government lifelines are withdrawn. But even better companies that had the balance sheets have just been materially weakened as post-lockdown revenues are below the previous levels, means that this resultant impact on liquidity throughout supply chains means we can anticipate, as I say, a sharp increase in insolvencies. So we are predicting a rise of 33% globally by the end of 2021. Okay. So just looking a little bit more at our proprietary data, if you like, in terms of what are we experiencing, and this is a little bit more specifically in the UK, but there would be similar trends evident elsewhere. But the first signs of financial distress are already evident. And if we look at this slide here, this is looking at the collection case volumes. So if you look at, towards the right-hand side of the chart, you'll see that, in the last sort of 3 months, there's been a steep increase in the volumes that our collections department are receiving. And the percentage of those, that we call large cases, which are, say, above 30,000, has also increased from typically, say, 10% to 17%. So, these are the first sort of signs, and this excludes the fact that these are cases that are actually passed to Coface for collection. We also must bear in mind that on the underwriting side, we are seeing a growth in the number of extension due date requests. So effectively where we were being asked where an extension outside the scope of the policy from a policyholder who has been asked to sort of delay by 30, 60 days. I mean, it's quite clear that actually many of these will ultimately evolve into either collection cases or potentially even claims. And I think another important point to make on the collection side is that typically we would see a recovery rate if we look over a sort of 12-month sort of period. Our sort of rolling recovery rate would be about 70%, but the metric at the current time is actually only around about 50%. And this is for a number of reasons. Obviously, as I mentioned already, obviously the drying up of liquidity, but also some businesses are inactive, and sometimes our collectors are unable to get in contact with anyone. So there are a number of factors there. But the point is, we can reasonably expect this upward trend, or deteriorating trend, to continue, even as we go into the post-lockdown phase. Okay, turning to the next slide, this looks a little bit more at claims. Similar to collections, the number of claims are receiving in terms of volumes and value is understandably increasing this year. So based on a 12-month moving average, this particular chart shows the trend lines. So this is of claims relative to indemnification. So in simple terms, it shows that the rising number of notifications notifications are translating into a claims payment. So whereas say around about 2016, we would typically be paying out and indemnifying a claim in around 1/3 of cases, it is now something over 50%. And this illustrates the fact that there's a tightening of liquidity, as I say, within the supply chains, but also because there's an increase in volume of insolvencies. That rising number of insolvencies is clearly a factor as well. And given the outlook for insolvencies I showed on the earlier slide, as I say, well over 30% increase predicted for the UK, we can anticipate, unfortunately, that particular trend continuing. And the final slide I wanted to share with you was really just sort of picking out a few specific sectors. Generally speaking, if you look at the dotted line there, which covers our sort of the entire portfolio. So this is on all UK debtors, both from our domestic and our import policyholders. The volume of claims that we receive. So this will be typically for notifiable events such as overdues or other adverse events. And that, as you can see from the chart, has been sort of progressively climbing since actually the trend started actually pretty much post-referendum, so in Q2 2016. Now, what we're seeing is that is, if you just look at towards the right-hand side, it's actually started ticking up. It's got a bit sharper, and the reason for that is obviously the impact of the pandemic. Notably, and we've got one there. So you see that very sharp increase in the blue line. TLE, that stands for travel, leisure, and entertainment, and so understandably, that has seen a very steep rise, proportionate to the level of exposure we have in that sector in claims. The similar things in transport, which is TRS, and retail as well. So all the, I guess, the sectors that you would expect to see some pain. But I think we should be mindful of the fact that it isn't just exclusively these well-known sort of sectors. Even if we look at some of the players while some of the players in the food sector have benefited, not necessarily everyone is immune to it, and there are a number which are, say, directly or indirectly exposed to the hospitality or the food to go demand shock. And this has created difficulties throughout the supply chain, from farmers to sandwich makers, and we had the recent insolvency of Deli Foods, which is one of the largest sort of sandwich makers, which occurred very recently, which gives you some sort of indication that even in agri-foods there are still potential problems. So, as I say, this was a very quick whistle-stop tour of some of the trends we've been seeing within the UK. Obviously, this plays into how underwriters are managing the portfolio of risk, and I'm sure there'll be opportunities to answer any questions that you have on this in the Q&A session after Patrick's presented his.
John, we already have got two questions which are very, very specific, so maybe you can take them now. They are related to collections. And basically, the question is, are the guidelines, the CSA guidelines, hindering collections? And the second one is, how do you manage collections when effectively the courts have been shut for a number of weeks?
Yeah, I mean, that's a good question. Sorry, if you can come back to the first one in a sec, but to answer the second one, I mean, obviously the initial stage of collections is without the legal recourse. So the collections are getting in contact with the buyer, trying to engage and resolve through some form of payment plan. The difficulties there actually, because as I said, one of the issues first and foremost is is there someone there that can be contacted that is able to even negotiate a plan? And secondly, and to be honest, understandably, a lot of these companies really don't have the visibility of their sort of future cash flow. A lot of the businesses, for example, in retail, as we know, the non-essential retailers are only just about to reopen next week. So a lot of them, and they've got no idea what the level of footfall will be, what the average basket spend will be. So it's very difficult for them to be able to provide any concrete sort of proposals. As far as the for those where legal action is required, I mean, sure, there's been for those where we get to that stage, there's been delays in the courts, and also, of course, the government have introduced some temporary measures to, if you like, protect debtors for a while from legal action, which obviously will mean that there are delays to those collections as well. And the first question, Frederick, was you mentioned?
It's about the CSA guidelines, and more generally, probably the fact that companies are being allowed to post. I extend the question: companies allowed to post their accounts later on Companies House. So what does this create for you in terms of underwriting and collections? The challenges that go with it.
Yeah, I mean, look, in a way, part of the answer ties into a broader question, which obviously is very topical, which is the announcement of the HMG scheme, the reinsurance scheme, which most of the credit insurance market have participated in, and it's clear there that basically there's an underlying responsibility for the insurers to perform their underwriting duties in the ordinary course of business as they would do, but they have to be say for example late filing of accounts would be. Sorry, I've just got a phone call coming in. So late filing of accounts would actually obviously be treated as an adverse event and something where underwriters would naturally take a cautious approach to the risk. But within the scheme, it's clear that that the additional 3 months that have been given for companies to file their accounts has to be taken into account. So that would be considered in that context. So that additional additional sort of leeway, if you like, given to buyers in this situation. Were there any other technical questions on those slides, Frederick?
At this stage, no, but they will be coming in later. So,
okay. As I say, happy to answer any further questions. But now I'll hand over to Patrick, who will provide some more in-depth economic insights.
Okay, I think I can start, guys. Frederick, is it okay for you?
Yes.
Okay, so good morning, everyone. So I'm pleased to do this short presentation on the world economy and what's ahead, probably. So the first thing I want to share with you is what's going on this year. So if you can just turn to the table. What you've got is our latest forecast for the large regions. So here we have two messages. One is overall, I mean, as you know very well, there's a very big drop in production this year. I mean, you see GDP for the OECD is down more than 7%, which is very close to what the OECD tells us this morning. And the second message is that the reaction of fiscal policy is extremely impressive. When you calculate the ratio of the change in the budget deficit to the loss in GDP, which is some form of a reaction ratio for fiscal policy. For the OECD as a whole, this ratio is around 100%. It's above 100% in the US, for instance. It's slightly above 100% in the UK as well. So we have a massive reaction of fiscal policy, which means that, and I will just go to that in a minute, if we were facing only a problem with demand, the demand side of the economy, this problem would be corrected by fiscal policies. So the big debate, as you know, today is not about this year, it's about the shape of the recovery by the end of this year and next year and in the future. So we have seen yesterday and this morning, a very negative reaction of the capital markets to the Federal Reserve. Federal Reserve yesterday makes a statement which is a very cautious statement about the recovery, telling it's not that rapid, it takes time, it's painful, it takes like 3 years to be back to normal. Whereas, I mean, if you look at what others have been telling us, like the IMF, like the European Commission, and the consensus of bank forecasters, there is the view that we might be facing a much more rapid recovery, which we decided to call a V-shaped recovery. So, and this, of course, is extremely important, both for your purposes. This is leading, basically, the number of defaults we might be facing. And this is also very important for the capital market. So what should we believe? I mean, the very optimistic view that the recovery will be very rapid, or the more cautious view that the recovery will be sluggish and painful. I'm more in the second group. I think we have a lot of arguments telling us that we should be very prudent when we assume the shape of the recovery. Corporates have been borrowing a lot. There is a massive increase in corporate borrowing during the crisis, but corporates are just offsetting the loss in sales by borrowing more. And if you got corporates with a higher leverage, it means lower investments, less jobs created, and this is something we already have been seeing after the subprime crisis, and we might have that again after this crisis. Second argument, and this is something we see very clearly in China, that the consumer is prudent. We have some precautionary savings continuing. This is the case clearly in China. It's the case also in Germany, in Austria. Seems to be the case in France as well. Savings rate is 7-8 points above where it was before the crisis. This is probably linked to the fact that people expect unemployment to keep rising, at least to the start of next year, which is not, of course, leading to a boom in spending. The third issue is the new health regulations. They are extremely important in a number of industries, manufacturing, construction, retail, and they lead to a big decline in productivity in these industries. My assessment is that overall for the euro area, productivity is down 6% because of these new health regulations. Of course, they might be lifted in the future, but we don't know when. And as long as they are there, they are a big obstacle, to a rapid recovery. And the last thing, and I think John already mentioned that, and that's extremely important, is that we have a big distortion of the economy at the sectoral level, at the industry level. As you know, we have a number of industries which are in a very bad shape. That's cars, air transportation, planes, tourism, retail, and we have a number of industries with very strong growth already. It's IT, telecom, payments, healthcare, pharma. And so this is basically we have a two-tier economy. And this is creating a big problem because what you should normally do is to move the jobs from the industries which are in a good shape to the industries which are in a bad shape, which is not that easy, which takes time, which is a very costly process, and which is, of course, costing some growth. So overall, I think that we have to have in mind that it's not that easy to recover from such a big shock, and that I share more the view of those who prefer that form of progressive and slow recovery to this idea that we might have an extremely rapid and V-shaped recovery. So let me say a further word, this is my second part, on the structural changes the economies might be facing. It's not only macro. I think at the more micro level, we have a lot of structural changes. I already mentioned one, which is extremely important, which is the change at the industry level. I mean, again, we have half of the economy which is in a very bad shape probably for quite a while, and half of the economy which is already improving. And this is very important, again, because, of course, in terms of the sectoral allocation of jobs, as I mentioned before, in terms of investments for investors, we have this clear-cut distinction between the two parts of the economy. And again, this is something which for me is a very important factor behind a slow recovery, but you are facing those industries which will remain in a very bad shape. So second new important sectoral structural factor, I think, is something we do not discuss a lot because we focus on the OECD, which is emerging countries. So if you can move to chart 2 in the handout, you've got one of the very clear causes. I can go to the next one. You get a very clear cause of the very painful situation in a lot of EM, which is commodity prices. You see here the big decline, not only in the energy prices, but in metal prices, in food prices. This is extremely harmful for emerging countries. We also had a massive outflow of capital from EM, which has been causing a big depreciation of the currency. This is correcting. Our currencies are reappreciating since the 2 last weeks, but still, we had this massive outflow of capital, which is creating a big liquidity crisis in EM. You've seen yesterday that more than 100 emerging countries are in trouble and ask for one form of support to the other from the IMF, which is impressive. And so this is also a source of weakness for the world economy, that we see this extremely difficult situation in many, many emerging countries. Third structural change, I think, is the situation in terms of the policy mix, and Frederick mentioned that in his introduction. We have an extraordinary policy mix. Fiscal policies, I mentioned before, are extremely expansionary. It would not have been possible without the support coming from central banks. And if we can go to the next chart, what you see, I think, is extremely impressive. It's public debt as a percentage of GDP. You see in the OECD, you see this big jump this year by about 20 points of GDP. So that's extraordinary increase in public debt. But if you can go to, well, we'll see that later because it's a bit further in the handout. So what was the reaction to that? It was a massive monetization of public debt. Through the OECD, central banks have been massively buying the increases in budget deficits, the new bonds supplied by the governments. We have seen the messages passed by Bank of England, by the Federal Reserve, by the ECB, by Bank of Japan, and others. So the whole of this increasing public debt basically has been purchased by central banks, and we know that this will continue at least next year. And so there is sometimes a very big misinterpretation of what we see here. Of course, we have an extraordinary increase in public debt to GDP, but it's not a real increase in public debt because, again, the whole of that is now lying on the balance sheet of central banks. It's been replaced by money. And you know that when a sovereign bond, when a government bond is purchased by a central bank, as long as it stays on the balance sheet of the central bank, it is just as if it has been cancelled. Central banks just give back their profits to the governments, so they give back the interest payments they receive from the governments. And of course, the bond doesn't have to be reimbursed. And the ECB, for instance, just to confirm that for a couple of years, whenever one of these bonds would mature, it will be reinvested in another bond. So there is no sign that central banks want to reduce the size of their balance sheet, which means, again, that we don't have to look at this increase in public debt as being a real one. In reality, this amount of additional public debt has been transformed into more money. And what we have is not an increase in public debt. What we have is an increase in money supply. And I'll be back to that in a minute when I discuss what's going on in the capital markets. So no fear about an excess of public debt, no fear that this would lead to higher long-term interest rates, no fear in the area of a new crisis with peripheral debts. I mean, as long as central banks keep the same policy of monetizing these new public debts, again, this increase in public debt has no effect at all on the economy. A word on something which Frederick mentioned and which is very, very important also if you look at the structural changes caused by this crisis, which is offshoring and onshoring. I mean, there is a lot of debates about onshoring, what's called nearshoring, producing closer towards the final buyer, user of the good is placed. In Europe, there is a lot of debate about reindustrialization, relocation of manufacturing to Europe, the same in the US, as you know. So we can skip that. I mean, and can you go to the two charts afterwards, just to show, if you can continue the charts. Yeah, next one and next one again. That's it. No, and next one again, sorry. I will comment this one here. Yeah. So we have a lot of discussions about relocations. I mean, of course, we've got two sources of relocations. One is coming from the governments. Governments want to relocate some, I would say, strategic industries, strategic productions. People speak about drugs, about telecom equipment, about equipment for renewable energies. And companies realized once more during this crisis that global value chains were very fragile. And it's not a question of basically of value chains being global or worldwide. It's a question, and we have a lot of academic research on that, that value chains are concentrated, but very few places where you produce a number of parts and components for manufacturing. And a lot of corporates want to diversify their risk, basically, so to produce in several places to be sure that there is no shortage anytime for their components. So we will certainly be back to more regional value chains. One for the Americas, one for Asia Pacific, one for Europe and Northern Africa and Eastern Europe. Does it go very far? I'm not sure. This chart here is showing you the level of unit labor cost. So the OECD is 100, and you see emerging countries, including China, around 50. So if you relocate to the OECD, you double production cost. And this is, of course, a massive obstacle to relocation. So my feeling, and speaking with many of our corporate clients, is that yes, we will have some relocations for strategic productions, for strategic parts and components, but that won't be a massive move. I don't see anything like deglobalization. There will be some limited relocations for some limited products, but I don't see that again as being as a macro factor in the future. Last thing I wanted to mention before perhaps going to the capital markets to conclude is this crisis is starting a big debate again on climate change and environmental issues. And there is no real link between climate change and the COVID crisis. I mean, of course, a number of people argue that climate change, deforestation is one of the causes of the pandemic. This is a bit, an illusion, I think. It's a bit stretched. I mean, because honestly, there is no scientific proof that what we see has anything to do with globalization. We had pandemics in the 14th century, I mean, well before globalization. Still, there is an enormous pressure from the opinions to accelerate energy transition, to accelerate environmental transition. And I think this is something which will have a big effect on corporates. I mean, we see many investors accelerating their transition to working more with ESG scores, asking for the carbon footprints of issuers and borrowers. So I think we will have to face a very big acceleration of energy transition and the pressure of investors on corporates. We have a big debate in continental Europe. I don't think this might be the same in the UK about capitalism, and this is very associated to the debate about climate change. I just want to show you one chart, so you can go two charts further to the next one. I think this is very interesting. If you want to debate about capitalism and corporates, in this chart, the top line is a return on equity in the OECD. You see it's about 13% today. And the bottom line is a riskless 10-year rate on government bonds. So you see this very, very interesting change that the risk premium paid on the capital of OECD's corporates has increased a lot. I mean, 30 years ago, there was a risk premium if you were investing in the capital of any corporate, like you see like 3-4%. Today, it's like 13%. And this is where the criticism of capitalism is coming from, that the risk premium paid to shareholders is too large. I mean, has kept whining, and this is, of course, I think a big pressure to stick to lower wages, to delocate production, to increase leverage. So just to show you where basically it's a very hot debate, especially in a country like France, about capitalism is starting from. Let me finish with a word on the capital markets. If you can go, yes, let me start with this. The first debate we have today on capital markets is whether inflation will reappear or not. It's an extremely important issue because if inflation reappears, as I said before, we have a lot of new debt accumulated by the governments, by corporates. Higher inflation would lead, of course, to higher rates, and higher rates would be an enormous problem at this level of debt to GDP ratios. What you see here is that, of course, this year, 2020, inflation goes to zero. We have a lot of inventories which have to be sold. We have much lower commodity prices. Question is not this year, it's in the future. One argument is that this crisis is harming productivity. We have these new sanitary health regulations. We have a lot of difficulties to organize working from home, for instance. So people argue that productivity will suffer, that unit costs will increase, and that this might lead to more inflation next year in the future. This is extremely difficult to quantify, but I can tell that this is something you are looking at. Of course, relocations are also inflationary. I said before, if you produce in the OECD, you double the cost. So the more we will relocate, the more inflation we'll have in the future. So inflation is something we have to monitor. Of course, higher inflation would be very bad news because, again, in a world of very high debt, this would be extremely complicated to manage for central banks. So next chart is, and I'm back to what I discussed. Yeah, you can go to that. Just to give you a flavor of where we stand in terms of liquidity of the capital markets. So this is very impressive, and this is base money. So this is exactly the same as the size of the balance sheet of central banks. So you see where we stand already after 3 months of crisis. You see this big increase in base money. By the end year, and you see the scale, it's about today $18 trillion. By the end year, it will be around $24 trillion. So base money will increase this year by about 80%. So in 1 year, money supply increases by 80%. This is pure craziness. This is a price to pay for financing the very large budget deficits. And a number of people argue that this is making these budget deficits and the crisis completely harmless. Basically, we have a very deep crisis, but no problem. I mean, we increase the budget deficit as much as is necessary to offset the loss in income. I said before that it was the case. And then, of course, we might have a problem with public debt, but we don't because central banks monetize public debt. And so basically, the crisis has no cost, no big increase in defaults. John showed a 33% increase in delinquency before. If you think that the GDP is down 9%, that's a very moderate increase, basically, in delinquencies and defaults. No big increase in unemployment. We're expecting in your area a 2-point increase in unemployment, which is extremely small compared to the size of the crisis. But this would be, of course, made possible by this extraordinary increase in base money. You cannot imagine that this has no cost. What is the price to pay for this policy? I think the price to pay is bubbles. We know that in modern economies, if you increase money supply a lot, you don't end up with more inflation in terms of goods and services. This correlation has disappeared in the 1990s. But you end up with higher asset prices, and you already see that, not, of course, on a daily basis, not today, for instance, but you see an improvement, a very rapid improvement in equity markets, tech stocks, for instance, yes. You see the money flowing back to EM. You see a lot of people investing in real estate. So what I'm expecting is basically a massive development of bubbles, of very rapid increases in asset prices, equities, real estate, private equity, infrastructures, whatever. So this will be the price to pay, and it's a form of tax. If you're a young person in the OECD, it will cost you a lot more to buy an apartment. If you want to save for your old age, you have to pay more to build your portfolio. So this is a tax on savers, a tax on the young people having to buy an apartment to invest in housing. And this is, again, the price we have to pay for the financing of this crisis. So let me conclude very briefly. So 2020, we have a massive drop in GDP. The differences between the countries are very simply linked to the severity of the lockdown or to the severity of the pandemic, which is very different from one country to the other. 2021 and later, I cannot really believe in the very rapid recovery. I think I mentioned that we have a lot of factors limiting the rapidity of the recovery. Very large structural changes, sectors which are fine, sectors which are very much in trouble. Which are in a very bad shape. The debate on climate, which will be a very, very important factor in our economies. And finally, capital markets dominated by liquidity. We will have liquidity-driven capital markets for a couple of years, and that's something, of course, we have to monitor. Thank you very much for your time.
Thank you, Patrick. Thank you, John. Again, you can ask questions either by chat directly to me, or you've got another way to ask questions which can be seen by all participants. Already a question, Patrick, mostly for you. At the beginning of May, the Bank of England mentioned the fact that the UK economy would contract by 14%. Mm-hmm. 3 weeks later, the same Bank of England said, actually, we might have been a bit pessimistic. Maybe it's going to be around 7.7%. 6 points of GDP in 3 weeks. So that is the question. How much exactly do all leaders know what they are doing?
Yeah. Well, the OECD this morning has, for the UK, says it's between 11 and 12. I'm closer to the OECD, actually. I think, no, -7, I cannot believe. Well, again, you've got two issues here, as well as mentioned. How long does the lockdown, has the lockdown been put in place, and how severe it is? It's very severe in the UK, the way it was basically in France, in Spain, in Italy. It's even longer in the UK. So I think it's very hard to believe that you can have -7. Statistical institutes made a lot of progress during this crisis, and we have a weekly measurement of GDP, which is impressive. And we know that in the UK, which is about the same as in France, in Spain, and in Italy, as long as the lockdown is there, the loss in GDP is above 30%. So if you lose 30% for 2 months, 2 months and a half, I mean, you're below -10. So can it go to -14? It very much depends on the supply side factors mentioned before. For instance, what is the severity of the sanitary health regulations? Take an example. I mean, in France today, in construction, you lose 20% of productivity. You've got to distanciate the workers. You've got to disinfect. I mean, the workplace or at all times. So it's costing 20% productivity. As long as it's there, it's very hard to believe in -7 in a rapid recovery. So I don't think there is such an uncertainty. I think the UK will go to -11, -12, very likely. For me, the uncertainty is more next year and afterwards. I mean, after the subprime crisis, it took 6 years to bring GDP back to where it was before the crisis in Europe, to 3 years in the UK. I cannot believe this time it can take only 2 years when it took 6 years in the last recession. And this is due, again, to supply side factors. Again, for instance, corporates have a lot of debt. So it's very complicated to reinvest, and so it's slowing down the accumulation of capital, and this is leading to slower growth. So again, Frederick, I think the uncertainty is weighting more on what we'll have in the next 2-3 years than on this.
So I think we have a question with the B word, which is Brexit. So I assume the question is twofold. The first one is, do you see a chance that an agreement be struck between the European Union and the UK for the end of the transition period? And the second question is, what do you foresee yourself for the UK economy, depending on that?
Well, I read, and I speak to him, I read what Michel Barnier is writing. So Barnier, I think, as time goes, Barnier becomes more and more pessimistic. I think there is a real Marnie's view. I just tell that from I would say a European Commission's perspective is that if you want an access to the single market, you have got to play the rules of the single market. And this is something which so far is, I would say, widely rejected by the UK negotiators. So as long as the European Commission says, if you want to enter a single market, to benefit from single market, you've got to have the same regulations for the financial sector, for climate, for whatever, I mean, for industrial safety. And as long as the UK says we want to have an access single market, but of course we want to be free to our own regulations, there is no possibility of an agreement. And I think the Europeans will not move. And for the Europeans, it's not negotiable. You cannot have an access single market if you don't play to the rules of the single market. Then what it does to the UK. I've always been very pessimistic, but for a very, I would say, not theoretical, but I would say basic reason, which is what we discussed before. If we're back more to regional value chains, which means that companies will produce more on a regional basis and less on a global basis. But what matters is is domestic demand, is the internal market on a regional basis. So if you produce in Europe, you will mostly sell to Europe. You will produce for European customers, consumers. Much less you will produce to export, and much less you will delocate to China to re-import to Europe. So if production moves closer to the final buyer of the good, basically what matters for the UK, like just for the like of us here on the continent, is the domestic market in Europe and Europe at large. I mean, Europe includes North Africa, Turkey, Central Europe. And so a strategy where the UK would try to grow by building global value chains linking the UK to China, to US, Pacific countries, it's a strategy, I think, which could have been something which could have been successful like 20, 30 years ago. It's not consistent with moving to regional value chains. If you move to regional value chains, what you produce in the UK has to be sold in the region. And this is just the opposite of today's strategy in the UK. So I'm very pessimistic on the effect of this on long-term growth in the UK.
Thank you. A question regarding it's probably more geopolitics than economics. It's about the balance of power between the US and China. Obviously, nowadays the US are blaming China for virtually everything. So it's quite a change because 1 year ago it was Russia. So we're seeing that the US economy is really struggling currently, even if there was some good news last week on the unemployment side. And the Chinese economy, if I trust at least the macro figures, seems to be trading along. So does this mean that there is a benefit in the way the Chinese have organized their economy and the way they plan ahead compared to, I would say, Western societies, or is there something which is not so obvious?
Well, and China is recovering, but not that brilliantly. When you look at the data, you've got retail sales, which are still much under, I think, 7% below where they were at the start of the crisis. And what's very weak is corporate investment. And this is something really, I think, is important, and we should monitor that, because in China, we see what I'm expecting for Europe and the US, that corporates will have been borrowing a lot, and they will be very, very cautious when it turns to investing. So corporate investment in China today is 15% below where it was before the crisis. We have seen the recovery in number of industries. Cars, surprising. Car sales are at the same level as last year. Of course, there is no catching up of what's being lost during the lockdown, but still, the level is the same as last year. Transportation is really improving. Freight is close to normal. Energy is really close to normal, a bit under normal. But again, it's not a very rapid recovery. So recovery with growth probably below where it was before the crisis, which means that you don't recover from the loss in income during the crisis. You just restart growing, but at a pace which is probably a bit low. I don't at all believe in the official prediction forecast by the Chinese government that the economy will go 8% next year. I think it might be 5 or 6. Now, is this due to the economic structure of China? Well, there is a massive stimulus in China. It's a massive fiscal, but not yet. It's starting, but a massive monetary stimulus. There has been a lot of additional borrowing, especially for local authorities and what's around local authorities. So our colleagues in China say, well, in a short-term perspective, it works, and you build more infrastructures at the local level. But in a medium-term perspective, you got a lot more debt, and debt was already one big problem of China. You know that domestic debt amounts to 260% of GDP in China. So they even have more debt, especially for local governments. And B, the lockdown has not been as severe as in Europe. I mean, there was a severe lockdown only in Hubei, not in the whole of China. So the economy has never been operating at such a low level as we have here. I mean, at the worst, in February, March, I mean, the Chinese economy was operating 80% of normal, which is much more than what we had in Europe. I mean, so it's also a very large country. Yeah? So the disease has not been affecting the whole country with the same seriousness. So again, I'm not sure there is something slightly artificial in the recovery in China. Again, there is an instrument they use a lot, which is to tell to local authorities to borrow more and to spend more on infrastructures, and they're using that again. But I'm not sure it's a very endogenous recovery. I mean, the private sector is still very prudent.
Since you mentioned recovery.
Sorry, okay, just add a sentence. Of course, it's very interesting because since the Athens, I mean, in very very long time ago, and through the big plague in the Middle Ages, I mean, when you have a pandemic, you always have a scapegoat. So the scapegoat in the US is China. The scapegoat in France is capitalism. The fact that the scapegoat in the US is China will have an effect, and we already see a new weakening of trade between China and the US, which is impressive. You look at US imports from China, they are down 40% from 2 years ago. And this is something which is also harming growth in the US, that they are basically closing trade with China.
So we have a question. You mentioned the amount of liquidity, and there's a question which has come, which is whether you fear a new banking crisis in the midterm, similar maybe to 2008 and 2009, despite all the government's efforts. And I would add to that question, maybe the fact that interest rates are close to zero doesn't help the banking sector either. So what is your view on the risk there?
No, I don't think we have a banking crisis. I think we have certainly the banks' incomes are down. Our estimate is that this year in the EU, the income of banks will be down 20%. But this is the banks can afford it. At the start of this crisis, the capital EU banks were having was twice the level of capital which, from a regulatory perspective, corresponds to the level of credit banks were having, the outstanding of their loans. So there was a wide margin in terms of capital. As you know, capital regulations have been slightly relaxed also because of the crisis. So I don't think we have a bank crisis. I mean, banks are lending a lot, but in most countries it's with a government guarantee. The size of the government guarantee ranges from 70 to 100%, and depending on the countries, but they don't take a lot of risk. Of course, the cost of risk is increasing, but it's increasing. But when you look at the data, it's not that big. It seems big because the base was very low before the crisis. But but it's the level of. So I don't see a bank crisis, honestly. I mean, I think banks are weaker, of course, in terms of earnings, but I don't see a bank crisis starting. Last time, remember, it started as a bank crisis, and it went to Europe because of the ABS market. If you look at the outstanding of ABS today, it's 7 times smaller than in 2007. So we don't have at all the same transmission of the crisis. And then even when banks do lend today to corporates, it's taking the euro area. I mean, they refinance from the ECB at -1%. So there is still a positive margin on the loans. So it's not done with a loss. There's still a positive margin. So no, I don't think we should be pessimistic. And I think capital markets are being way too pessimistic about European banks. When you look at some stage, I mean, value to book at some stage was like 35%. Today it's a bit about 50%, but it's crazy. I mean, when you have value to book at 35%, doesn't mean anything. So I think banks are, of course, it's a big shock, but they are reasonably in good shape.
Thank you. Question for John. We've talked a lot about the recovery next year, and it may take 1, 2, or 3 years, but nevertheless, after such a dip in 2020, it is clear that in 2021, normally there will be a fairly substantial recovery. Whether it's sufficient or not is another matter. So normally with growth, should we expect risk to effectively reduce or credit risk to reduce, or are there any other types of risks which might emerge in terms of, trade receivables and credit risk?
Yeah, I think as I mentioned in the presentation that the risk, as I say, in the recovery stage following a recession is at least as high as in the recession itself. And there are a number of additional factors in this particular recession, which probably sort of add the fuel to the flames. As Patrick sort of mentioned, there's been a huge amount of government support through most of the major markets in terms of a lot of corporate support, as we've seen in the UK. The large loans for the larger corporates through the COVID corporate financing facility, but also the CBILS for smaller ones. So at some point, of course, these are not grants; these are loans. So a lot of companies would have taken on effectively this additional debt, which will need to be repaid. We've got to remember that also the recovery is likely, it's the speed of recovery is likely to be different from one sector to another. And this means, as I mentioned, that for a number of businesses, it's going to take them a long time to get to the level of revenues that they say they had in Q1 of this year. It might, depends on what sector they're in, but that will have an impact. And those businesses, for example, that rely on invoice discount financing, they've had an absence of sales in many cases for the last sort of 2 to 3 months. So it's going to impact on the availability under those funding lines. But equally, this period of inactivity means that they've been burning cash in this period. So the level of liquidity they'll have coming out of as they restart economic activity is going to be critical as well. I think there's a myriad of issues to consider to be frank. I mean, for example, consumer behaviour is likely to be changed for many months, if not years. And in the UK, for example, where we have a very consumer-driven economy, we can anticipate a very cautionary spending, for example, on larger discretionary items, so consumer durables like vehicles and furniture, but also sort of tourism as well. There's going to be an effect, obviously, and there's a big, services are a big element of our economy. It's there are going to be a number of businesses that I feel will have suffer quite a bit of a medium-term sort of struggle. So coming back to the point, we expect though that level of insolvencies and high levels of credit risk, if you like, or a difficult credit risk environment to be sustained throughout 2021 and beyond.
Thank you, John. Follow-up question on the government scheme. So it still needs to be approved by the European Union, but there's a question regarding the way we will handle generally credit limits, reinstatements, or underwriting policy. Obviously, this will be taken offline between the account managers and clients and brokers, but can you already give some ideas of the philosophy of what you intend to do?
Yeah, I mean, in very general terms, as you say, it's something which is, can be discussed in more detail, sort of offline. But the primary objective of the scheme is to support UK business and aid economic recovery following, the COVID-19 pandemic. And one of the centerpieces of it, from the government perspectives, was to avoid any sort of mass or bulk limit actions or exposure reduction actions, but by the credit insurance market. So, Coface itself hadn't engaged in any, hadn't planned to engage in any sort of mass reductions anyway. We've been very sort of selective. So, in terms of the underwriting approach, it doesn't have a huge impact on our sort of day-to-day operation. What it does require is for all participating insurers to conduct their operations in what would they say, an ordinary and usual manner, which means it should be at least comparable to the pre-crisis situation, say in Q1 2020. So we should be, the Coface underwriters, my team will be, sort of underwriting in a normal way, conducting their risk monitoring in an ordinary way. At the same time, looking to support businesses where that support is justified, businesses which have just been had their business temporarily interrupted by this crisis, but the expectations are that they will be viable, as I say, once they get through this temporary difficult period, and therefore merit support. But to be clear, the scheme is definitely not designed to prop up poor risks, ones where underwriters would have in any event sort of taken action, say for example on the limits. But it's getting, as I say, so it is getting the right balance. There are, for example, there would definitely be buyers out there, companies where cover was removed simply because they've been inactive. So it hasn't necessarily constrained the business because they wouldn't have been placing any sort of orders. And now underwriters have the chance to evaluate the financial condition of those buyers as they come. As I say, now we start coming out of the lockdown phase and activity starts building again, and each one will be looked at on its own merits, so on a case-by-case basis, and certainly where cover has been removed, it will be reinstated as once we have the information as quickly as possible.
Thank you, John. One last question apart, of course, if there are any others which come in the meanwhile, we'll take them. But one last question for Patrick, maybe. Again, it's about the uncertainty in terms of the economic outlook and whether we can start to make forecasts about the end of the year or 2021. At what point do you believe, Patrick, that we will start to know exactly where we are and where we are heading for? What do you need to have a level of certainty?
I think, it's not an easy question, because I think we first have to know when the new health regulations will be lifted. I think you had the same debate in the UK as we have in here on the continent. I mean, that the business community is putting a lot of pressure on the governments that they lift these new health regulations sooner. There were basically governments were thinking of maintaining these regulations probably to next year, and in some cases as long as we don't have a vaccine. Business community says this is an enormous problem for them. industries I mentioned before, and putting a lot of pressure on governments. So as long as we don't know how long these new health regulations, which are there everywhere in Europe and even in the US, will be maintained, it's very hard to do really a forecast, because if you take my estimate for for the euro area, these regulations are costing 6 points in terms of GDP. So they are lifted, you can regain 6 points of GDP, and of course it's a tremendous improvement in the outlook. So I first need to know when the governments will at least relax some of these regulations. I mentioned before the construction industry. In France, they are putting an enormous pressure on the government, saying you are killing our businesses by having a production cost increase by like 20% because of these regulations. So again, this is, I think, for me, the first stage, in having a improvement in the economy. Of course, we need to know if there would be or not a second wave in the pandemic. In the US today, as you know, there is a debate that the second wave might be starting right now. Got the same debate in India, in Pakistan, in South Asia. In Europe, so far, nothing such seems to happen, but of course, it's very important. And then we've got to know more about the recovery programs of the governments and the European Union. For instance, as you know, in Europe, there is this project to have 750 billion euros of investments done at the European level. It will be a massive support to growth. So in the most rosy scenario, governments lift the health regulations like in September and not next year. There is no second wave for the pandemic, and the Commission puts in place this 750 billion euros investment fund. And in that case, you turn to being much more optimistic. Perhaps in that case, you may have like 6% growth in Europe. If you keep the regulations, if the Commission fails in putting this investment plan in place, investment program in place, and if there is a second wave, of course, you go to a much lower figure. So again, it's too early to know. So today, I would say that next year we are in a 4 to 6% range. To get to the top of the range, you need these three conditions.
All right. Thank you very much, Patrick. Thank you very much, John. And thanks all for joining us this morning. I hope you enjoyed the presentation and you learned from these Q&As as well. We will try to organize more events, bite-sized events over time. And meanwhile, I wish you all a very good day and talk to you soon. Thank you very much.
Thank you.
Thank you.